Well, Ridham Desai, Head of India Equity Research and with Morgan Stanley joins us. Ridham, good morning. Is my voice reaching you? Okay, perhaps not.
Morning.
Okay, let's... okay,
yes,
good morning, Ridham.
Good morning, Nikunj. Good morning, Aisha.
Always good to connect with you. Always a pleasure to cover the Morgan Stanley conference. Let's start this interaction with a big smile on your face. I mean, everything is going for us. Macro, micro, liquidity, and now even monsoon.
Yeah, so that's right. But even share prices are higher, Nikunj.
So, Ridham, my question is that, good news and good prices, they rarely come together. Now, we know that the scenario and the construct is strong, but what about prices and valuations?
No, so good news and good prices come together very often, as do bad news and bad prices. Usually, it's the former, the latter is when you want to buy shares. But as far as valuations are concerned, I don't think there's much to worry about. In fact, I don't think the valuations actually are at levels where we can make a call purely based on valuations. So valuations are useful to make market calls when they are at extreme levels. So if say on the Sensex, the price to book is trading at over 5 times book or around 2 times book, then you can go and thump the table and make the call that stocks are too rich or too cheap. But when it is trading at 3.2 times or 3.3 times as it does now, which is bang in the middle of its historical range, there's really not much you can make on valuations. You have to rely on other indicators like growth and sentiment to judge where you are in the market cycle. So I think we are far away from bubble territory, if that's what you're alluding to. That said, of course, sentiment is clearly more buoyant, certainly more buoyant than last December. And that was the moment to buy the markets when people were very depressed and people were worried about the impact of demonetization. Now I think sentiment has turned around and people are far more optimistic, and that is the better tool to use rather than valuations.
Ridham, hi, morning. This market has somewhat been a hope trade so far, hoping that earnings recovery would come in. Having said that, the earnings season has only been better than what the street was expecting, about a 50-50 to the nays and yeses. What is your sense on where we're likely to see a more pronounced earnings recovery in the next quarter?
So Aisha, on your first comment, markets are forward-looking animals. 8 out of 10 times they are right. They are wrong only 2 out of 10 times. Those are occasions when valuations get to extreme level and you want to take a contra position on the market. In normal circumstances, to stand against the market, it can be very painful and requires infinite patience and a lot of holding power. So there is no merit in doing that. Now, as far as earnings are concerned, you're right. I think the earnings cycle is turning. We have that view. And the earnings could be at the beginning of a new 5-year cycle. We could see earnings compound at about 20% every year. And just to put it into context, in the previous cycle, that is between 03 and 08, earnings compounded at about 40% for the Nifty for 5 years or 4 years. So this is not as strong as that earnings cycle because global growth is nowhere close to 5%, is unlikely to go there. But profit to GDP, the share of profits in GDP are starting from a low point. So I think there's a reasonable chance that earnings rise over the next 4-5 years. And if earnings CAGR at 20% over the next 5 years, then you will see some expansion in the PE multiple because that's usually how the market behaves. It tends to get more optimistic. So on a 5-year view, the Nifty could do very, very well. On your question on what the earnings will do next quarter, I think the trajectory that we've seen in the last quarter probably continues. So there is an upward move. Revenue growth is accelerating, margins are improving. So I think earnings will do well. As far as sectors are concerned, I think it will be probably led by financials and consumer discretionary, to some extent materials, to some extent energy. I think telecoms continues to lag, utilities and pharmaceuticals and technology happen to be middling performers. And industrials could, I think also show strong performance. So that could be the sectoral composition of earnings over the next quarter.
But do you think there is scope for P expansion for financials? And when I say financials, private banks, I mean the good quality private banks are trading at price to book which are north of 3.5 to about 4 times.
So Nikunj, I think the absolute multiple is no indication of what the value is, because you have to see it in the context of earnings power and return on capital. The setup in the banking sector is that the state-owned banks have 70% market share and are short of capital and are likely to give up market share, where aggregate loan growth is somewhere in the low double digits, but private sector banks will probably do much better than that because they will gain share from public sector banks. So in that scenario, the return on capital and the growth that these banks can report, I think can support such type of valuations. So I wouldn't be too worried about the valuations in the private sector banks. Of course, there are some outliers. Some non-banking finance companies trade at much higher multiples, and therefore they are demanding more growth. Some of them will deliver that growth, others may not. So I think you have to be careful about those things. And there are others that are trading actually below these average levels because their businesses are threatened or are looking vulnerable. And those I think require careful examination as well, because maybe those represent opportunities as you go into an upcycle.
Right. Ridham, you're making a very strong case for upcycle, and for upcycles to start, we have to see a strong demand resurgence. So what is the bull case here for demand to come back?
So Nikunj, demand is already coming back. Consumption demand is fairly strong. There are underlying structural factors as well as cyclical factors at play. But just to step back a moment, as far as the economy is concerned, export growth is on a recovery path, because we are seeing recovery in global growth. We are seeing a recovery in government capex. In fact, that is likely to hit all-time highs in the subsequent 12 months. We're seeing some recovery in discretionary consumption. The only missing piece is private capex. But as a consequence of the recovery in the other three, utilization rates go up in the next 12 months, and I think it's fairly it's fairly clear that capex in the private sector will also start improving over the next 4 to 6 quarters. So I think the economy is on the mend. The reason why consumption demand is looking good cyclically is because inflation has come down and therefore real wages are rising, both in urban India as well as rural India. And the structural reason is because the current millennial generation in this country, which is bulk of the consuming population, are willing to leverage their balance sheet and therefore advance their consumption. There's also another reason, which is, per capita income in India is undergoing a J-curve effect. So, the share of food, which is very high in India, is unlikely to actually go up now. It will probably lose share. And it will lose share to other items in the consumption basket. So those will experience much faster growth rate than nominal incomes. So a lot of factors at play here, both structural and cyclical, which makes me fairly optimistic about consumption over the next few years.
How critical is the fact that one should have a monetary easing stance, or rather how critical is the monetary policy in itself to your assumption that the index is set to treble in the next 5 years? Because yesterday we were chatting with Chetan from your team, and he said that second half we actually may see the monetary policy getting tightened and rates getting hiked. Is that a critical assumption that one needs to make, or rather is it a critical assumption that needs to play out, or do you think bereft of that the market will do what it has to and it will shoot up in the next 5 years?
No, so Aisha, it's incorrect to conclude that equity markets only need falling interest rates. The US has been experiencing rising interest rates. The Fed has been hiking in America, and yet the SPX is in an entrenched bull market. So the reason why the central bank moves rates is far more critical to stocks than where actually rates go. So the reason in the US, for example, why the Fed is hiking rates is because they see growth. They see the prospects of normalized inflation. And that combination is very potent for stocks. Likewise in India, when the RBI was hiking rates in 2013-14, it was to combat inflation. That wasn't necessarily negative for stocks because the impact of that would have been that growth would have recovered. So the stock market did not react negatively. And as inflation got combated, the case for further cuts in interest rates is certainly not there. And if that is the case, and if growth is recovering, there's no need for the markets to actually get lower interest rates to perform. The fact that the RBI also concurs that the growth cycle is turning and that inflation has done its bit is actually positive for stocks. So I don't think it's critical to the input on our view on the market. What is more critical is where is the growth cycle. And if you are looking at the market with a 1, 2 or 3, 4 quarter view, then the only thing you should be concerned about is where's growth going, not where rates are going or where other factors in the, for example, what's happening to the government policy framework, etc. Excuse me.
Ridham, aside from the local growth cycle, let's talk about the broader setup. And like you've always said in the past that every bull market has a personality. And I'm getting a sense that the personality of this bull market is that there is very low volatility, both for us and for global markets as well. At a time when so much of liquidity is sloshing around, the world is dominated by algorithm and machine-based, emotionless trading. Why is there so low volatility in the market?
I think that's a very good point, Nikunj, and it obviously requires deeper examination. So one of the reasons why the volatility could be low is because market participants perceive this to be a cycle where growth volatility is likely to be low. Ultimately share prices reflect what underlying fundamentals are going to be. So for example, if I were to step outside India and say look at the US, maybe it's a low growth, low volatility environment, which is you're not in an environment where growth volatility will be high and therefore there's no need for share prices to be more volatile. There are technical factors also at play which contribute to this volatility. So I think there's a combination of stuff that plays into this. Now from a stock market perspective in India, I think the risk is that the volatility will spike at some point in time. Timing that is almost impossible, but the fact that it is so low and it could persist for months at these low levels, but at some point in time it will spike. So I think you have to keep an eye on that. Now, is there any event around the corner that could cause the volatility to spike? And I think there is, which is GST execution starting from July 1st. So we just did a proprietary survey of small and micro enterprises in India. So these are not listed companies. Listed companies are actually large companies in the context of GST. These are really small firms across the length and breadth of the country. Out of the 8 odd million firms that are going to be in the GST network. And their preparedness for a July 1st launch is not that high. So there is a risk that there may be some volatility around GST because as that news flow comes in, the market may sense that growth may wobble a bit. Now, how the market precisely reacts, I think, is going to be a function of what happens to global markets. And if global markets at that point of time also go through some sort of correction because of some other factor, I think it will induce a correction in the Nifty as well. So I think we need to keep a watch on this event. It's slightly different from the demon event. I would characterize the demon event as an unknown. We didn't know about it and we didn't know the impact of it. GST is, I think, in the category of known unknown, which is we know about the event, but we don't know the impact of it. So I think the market has to deal with this over the next 3-4 months. And given the low levels of volatility, both realized as well as implied, I think we need to keep a watch. Volatility could spike.
Ridham, I know some of our common friends who've been attending the Morgan Stanley conference and they quite enjoyed last evening's panel where you were moderating and Mr. Junjunwala and Rukshad were there. Now, I call that a serious disruption. If brokerage heads are becoming anchors, then should we worry?
No, you have no need to worry, Nikunj. You're one of the best anchors in the country. Why should you worry from for competition from me. I am nowhere close to competing with you, don't worry.
No, it's just that, some of my friends who have been attending the conference, they have the nicest things to say. Apart from good food, lovely hospitality, they're also enjoying the entire, galaxy of speakers there. So have fun at the Morgan Stanley conference. Unfortunately, I couldn't be there, but let's hope that
it's very kind of them.
Yes, please.
I said it's very kind of them to give you such comments, and I really appreciate that. But don't worry, I'm not competing with you. I'm just doing my job.
So are we. Okay, Ridham. Good to see you and have you on the show as always.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.